Summary of the Lords of Easy Money by Christopher Leonard. In The Lords of Easy Money, How the Federal Reserve Broke the American Economy, Christopher Leonard delivers a gripping and meticulously researched narrative that pulls back the curtain on one of America's most enigmatic institutions, the Federal Reserve. Through the lens of monetary policy, Leonard explores how the Fed's actions, particularly its embrace of quantitative easing, QE, since the 2008 financial crisis, have reshaped the American economy in ways that have exacerbated inequality, fueled financial instability, and left the nation on precarious economic ground. The book centers on the story of Thomas Hoenig, a dissenting voice within the Fed, whose warnings about the dangers of easy money policies went unheeded. Leonard's narrative weaves together economic history, personal stories, and sharp analysis to argue that the Fed's interventions, while often cloaked in the guise of economic salvation, have created a house of cards that threatens the future of the American economy. The rise of the Federal Reserve's power. In the early 20th century, the United States was a nation teetering on the edge of economic chaos. Panics, like the one in 1907, sent shockwaves through Wall Street, exposing the fragility of a banking system with no central anchor. Bank runs were common, savings vanished overnight, and the public's trust in financial institutions hung by a thread. It was in this crucible of uncertainty that the seeds of the Federal Reserve were sown, a system that would grow into one of the most powerful institutions in the world. The story begins in 1910, on a secluded island off the coast of Georgia, Jekyll Island. A group of influential bankers and politicians, led by Senator Nelson Aldrich, gathered in secret, their meeting cloaked in the guise of a duck-hunting trip. They were there to solve a problem: how to stabilize an economy prone to wild swings without ceding too much control to the government or the public. The plan they crafted became the blueprint for the Federal Reserve System, a compromise between private banking interests and public oversight. By 1913, after fierce debates in Congress and a nation wary of centralized power, President Woodrow Wilson signed the Federal Reserve Act into law. At its inception, the Federal Reserve was a modest entity. Its mandate was straightforward: manage the nation's money supply, stabilize banks, and curb the cyclical booms and busts that plagued the economy. 12 regional banks, overseen by a board of governors, would act as a decentralized counterweight to Wall Street's influence. But the Fed's role was about to evolve, shaped by crises that demanded more than mere stabilization. The Great Depression of the 1930s was the first major test. As unemployment soared and banks collapsed, the Fed's initial response was timid, constrained by a gold standard that limited its ability to inject money into the system. Critics argued it did too little, too late. The fallout forced a reckoning. New Deal reforms, including the Banking Act of 1935, strengthened the Fed's authority, centralizing power in Washington and giving it greater control over monetary policy. The Fed began to emerge as a proactive force, not just a reactive one. World War II further expanded its influence. To finance the war effort, the Fed pegged interest rates low, ensuring the government could borrow cheaply. This set a precedent. The Fed wasn't just a banker's bank. It was a partner to the state, capable of shaping national priorities. By the 1950s, it had won its independence from the Treasury, free to set interest rates without political pressure. This autonomy, cemented under Chairman William McChesney Martin, marked a turning point. The Fed could now steer the economy with a precision that rivaled fiscal policy. The late 20th century saw the Fed's power reach new heights. Under Paul Volcker in the 1980s, it tamed runaway inflation by hiking interest rates to punishing levels, a move that triggered a recession but restored faith in the dollar. Volcker's successor, Alan Greenspan, presided over decades of growth, earning the nickname the Maestro for his deft handling of monetary policy. Yet, Greenspan's era also sowed seeds of controversy. Low rates and deregulation fueled asset bubbles, culminating in the 2008 financial crisis. That crisis was the Fed's defining moment. Under Ben Bernanke, it unleashed an arsenal of unconventional tools: quantitative easing, zero interest rates, and massive asset purchases. The Fed didn't just stabilize banks, it propped up entire markets, from mortgages to corporate bonds. Its balance sheet ballooned, and its actions blurred the line between monetary policy and fiscal intervention. Critics cried foul, accusing the Fed of overreach, while supporters hailed it as the savior of the global economy. Today, the Federal Reserve's power is unparalleled. It sets the tempo of global markets, influences everything from mortgage rates to stock prices, and acts as a de facto regulator of economic life. Yet, its rise has sparked unease. Some see it as too opaque, too entwined with Wall Street. Others question whether its independence shields it from accountability. As the Fed navigates a world of digital currencies, climate risks, and geopolitical upheaval, its role continues to evolve, a testament to its ability to adapt, and a reminder of the immense responsibility it wields. The story of the Federal Reserve is one of ambition, adaptation, and controversy. From a secretive meeting on Jekyll Island to a global financial juggernaut, it has reshaped the economic landscape. But with great power comes great scrutiny, and the Fed's next chapter will be written in a world that demands both stability and accountability. Thomas Hoenig, the dissenter. In the marble halls of the Federal Reserve, where consensus often cloaks debate, Thomas Hoenig stood out like a lone prairie wind cutting through a still afternoon. A Midwesterner with a farmer's pragmatism and a banker's precision, Hoenig spent decades at the Fed, culminating as president of the Kansas City Federal Reserve Bank from 1991 to 2011. But it was in the crucible of the 2008 financial crisis and its aftermath that he earned his reputation as a dissenter, a voice of caution in an era of unprecedented monetary experimentation. Hoenig's story begins in the heartland, in Fort Madison, Iowa, where he was born in 1946. Raised in a small-town world of thrift and accountability, he saw firsthand how economic policies affected Main Street, not just Wall Street. After earning a doctorate in economics, he joined the Kansas City Fed in 1973, climbing the ranks as a steady, unflashy regulator. By the time he became president, he was known for his deep skepticism of financial overreach and his belief that banks should bear the consequences of their risks. The early 2000s tested that conviction. As the housing bubble inflated, fueled by loose credit and exotic financial instruments, Hoenig grew uneasy. From his perch in Kansas City, he warned of rising leverage and the dangers of deregulated markets. His concerns, rooted in a career spent supervising banks, were often overshadowed by the prevailing optimism of the Alan Greenspan era. The Fed, enamored with low interest rates and market-driven growth, wasn't eager to hear a contrarian from the Midwest. When the 2008 crisis hit, Hoenig's foresight was vindicated, but the victory was bitter. Banks collapsed, unemployment spiked, and the Fed, under Ben Bernanke, unleashed a tidal wave of interventions, bailouts, near-zero interest rates, and quantitative easing. Hoenig didn't dispute the need for action, but he feared the long-term costs. As a voting member of the Federal Open Market Committee, FOMC, in 2010, he found himself at odds with the Fed's direction. While colleagues embraced ultra-loose policy to stimulate growth, Hoenig saw a different danger: distorted markets, inflated asset prices, and a moral hazard that rewarded reckless behavior. In 2010, Hoenig made history. He dissented at all 8 FOMC meetings that year, a rare act of defiance in a body that prized unity. His votes weren't against stimulus outright, but against the Fed's commitment to keep rates near zero for an extended period. He argued that such policies risked fueling new bubbles and eroding the Fed's credibility. In speeches and writings, he called for higher rates sooner, stricter bank capital requirements, and a return to simpler, more accountable banking. His mantra was clear: the Fed was saving the economy at the cost of its future stability. Hoenig's dissents were more than symbolic. They challenged the narrative that the Fed's actions were universally necessary. He drew on his experience as a regulator, pointing to the 1980s savings and loan crisis, where lax oversight and easy money had led to disaster. He worried that quantitative easing, essentially printing money to buy bonds, would flood markets with liquidity while doing little for ordinary workers. His warnings resonated with a public frustrated by bailouts that seemed to favor Wall Street over Main Street. Yet, Hoenig was no populist firebrand. His arguments were measured, grounded in data and history. He spoke of allocative efficiency, warning that low rates distorted investment decisions, propping up weak firms and starving productive ones. He criticized the Fed's growing role as a market puppeteer, arguing it was straying from its mandate. In a 2010 speech, he invoked the Fed's original purpose, to act as a lender of last resort, not a permanent crutch for the economy. His stance made him a hero to some and a thorn to others. Economists like Paul Krugman dismissed him as out of touch, arguing that the economy needed aggressive stimulus to avoid a depression. Within the Fed, his dissents strained relationships, though colleagues respected his integrity. Hoenig, unfazed, saw dissent as his duty. "If you're not willing to stand up for what you believe," he once said, "you're not doing the job." After retiring in 2011, Hoenig didn't fade into obscurity. He joined the FDIC as vice chairman, pushing for tougher regulations on megabanks. He advocated breaking up too big to fail institutions and co-authored proposals to rein in risky trading. Later, at the Mercatus Center, he continued critiquing the Fed's overreach, warning of asset bubbles and inequality driven by easy money. His 2018 book, The Fed's Pivot, distilled his philosophy. Central banks must prioritize long-term stability over short-term fixes. Hoenig's warnings have aged well. The low-rate era he criticized fueled stock market booms and housing surges, but also widened wealth gaps and left the Fed with less room to maneuver in later crises. When inflation roared back in 2021, some saw it as the reckoning Hoenig had predicted. Yet, his legacy isn't just about being right. It's about the courage to challenge orthodoxy in a room full of consensus. Thomas Hoenig, the small-town economist who dared to dissent, reminds us that power thrives on scrutiny. In an age of complex financial systems and emboldened central banks, his voice, clear, stubborn, and principled, still echoes, urging caution in a world all too eager to gamble. The consequences of easy money. In the wake of the 2008 financial crisis, the world's central banks, led by the Federal Reserve, opened the floodgates of easy money. Interest rates plummeted to historic lows, and trillions of dollars were pumped into the economy through quantitative easing, a grand experiment in monetary policy. It was a desperate bid to stave off collapse, to revive a global economy teetering on the brink. The immediate results were hailed as a triumph. Markets stabilized, banks survived, and a depression was averted. But beneath the surface, the seeds of unintended consequences were taking root, reshaping the economic landscape in ways that would haunt the decades to come. The story begins in the chaotic autumn of 2008. Lehman Brothers had collapsed, credit markets froze, and panic gripped Wall Street. The Federal Reserve, under Chairman Ben Bernanke, acted swiftly. Rates were slashed to near zero, and the Fed began buying up government bonds and mortgage-backed securities, injecting cash into a system starved of liquidity. Other central banks, from the European Central Bank to the Bank of Japan, followed suit. The goal was simple: make borrowing cheap, encourage spending, and kickstart growth. For a while, it seemed to work. Stock markets roared back, corporate profits soared, and the unemployment rate began to tick downward. But easy money was a double-edged sword. Low interest rates, meant to stimulate, began to distort. In the housing market, the scars of the subprime crisis were still fresh, yet cheap credit reignited demand. Home prices in cities like San Francisco and New York climbed to dizzying heights, pushing first-time buyers out of reach. By 2015, whispers of a new housing bubble were growing louder, fueled not by predatory lending, but by the sheer availability of inexpensive loans. For the average family, the American dream of homeownership slipped further away, while investors and corporations snapped up properties, turning neighborhoods into portfolios. The stock market, too, became a creature of easy money. With bonds offering paltry returns, investors poured cash into equities, driving indices like the S&P 500 to record highs. Tech giants like Apple and Amazon became trillion-dollar behemoths, their valuations untethered from traditional metrics. But the rally wasn't universal. Small businesses, unable to access the same cheap capital as corporate giants, struggled to compete. The wealth gap widened, as those with assets, stocks, real estate, rode the wave, while wage earners watched their purchasing power stagnate. By 2020, the top 1% of Americans held more wealth than the bottom 90%, a disparity fueled by a market addicted to low rates. Easy money also bred complacency. Banks, once chastened by the crisis, returned to risk-taking. Corporate debt ballooned as companies borrowed at rock-bottom rates to fund stock buybacks and mergers, not productive investments. By 2019, U.S. corporate debt had surpassed $10 trillion, with much of it rated just above junk status. The Fed's implicit promise that it would backstop markets created a moral hazard. Investors and executives bet big, knowing the central bank was unlikely to let the system fail. This Fed put, as it was called, emboldened speculative frenzies, from cryptocurrency booms to the meteoric rise of meme stocks like GameStop in 2021. Globally, the consequences were no less profound. Emerging markets, flooded with cheap dollars, saw their currencies weaken and debt levels soar. Countries like Turkey and Argentina, reliant on foreign capital, faced currency crises when the Fed hinted at tightening policy. Meanwhile, in Europe and Japan, negative interest rates, a bizarre offspring of easy money, punished savers and strained pension funds. Ordinary citizens, expecting their savings to grow, found themselves squeezed, while banks grappled with shrinking margins. The promise of stimulus had become a trap, with central banks unable to raise rates without risking economic havoc. Perhaps the most insidious consequence emerged in 2021, when inflation, long dormant, roared back. The Fed had kept rates low even as the economy recovered, and pandemic-era stimulus checks flooded the system with cash. Supply chain snarls and labor shortages compounded the problem, but easy money was the kindling. By 2022, U.S. inflation hit 9.1%, a 40-year high, eroding wages and savings. The Fed, caught off guard, scrambled to raise rates, but the damage was done. Higher borrowing costs triggered a sell-off in stocks and bonds, while homeowners faced soaring mortgage rates. The era of cheap money had ended, but its hangover lingered. The social and political fallout was equally stark. Easy money had widened inequality, fueling resentment among those left behind. Populist movements, from Occupy Wall Street to the Brexit vote, drew strength from a sense that the system was rigged for the wealthy. Central bankers, once obscure technocrats, became lightning rods for public anger. The Fed's independence, a cornerstone of its authority, came under scrutiny as politicians on both sides demanded accountability. In a world of rising prices and shrinking opportunities, the perception that central banks had favored elites over workers was hard to shake. As the 2020s unfolded, the consequences of easy money continued to ripple. The Fed's balance sheet, once a modest $800 billion, had swollen to nearly $9 trillion, a testament to its role as the economy's backstop. But the tools that saved the world in 2008, low rates, asset purchases, had lost their potency. With inflation persistent and debt levels high, central banks faced a dilemma: tighten policy and risk recession, or stay loose and fuel more bubbles. The era of easy money had reshaped markets, societies, and trust in institutions, leaving a legacy as complex as it was contentious. The story of easy money is a cautionary tale of good intentions gone awry. It began as a lifeline, a bold response to crisis. But over time, it warped incentives, inflated inequalities, and sowed the seeds of instability. As the world grapples with its aftermath, the lesson is clear. Even the most powerful tools, wielded with the best of motives, can carry costs that echo for generations. The Fed's trap position. In the spring of 2025, the Federal Reserve found itself in a bind, caught between the weight of its own history and a world demanding answers it could no longer easily provide. Once the unassailable architect of global finance, the Fed now stood at a crossroads, its tools dulled by decades of overuse, its options narrowed by a web of economic, political, and social pressures. This was no mere policy dilemma. It was a trap forged by years of easy money, soaring debt, and a public increasingly skeptical of the central bank's power. The Fed, for all its might, was stuck. The story traces back to the 2008 financial crisis, when the Fed, under Ben Bernanke, unleashed an arsenal of extraordinary measures. Near-zero interest rates, quantitative easing, and emergency lending programs saved the economy from collapse, but they also set a precedent. The Fed would always step in to stabilize markets. This implicit guarantee, dubbed the Fed put, emboldened investors, inflated asset prices, and ballooned its balance sheet to nearly $9 trillion. Successive crises, the European debt scare, the pandemic, only deepened the Fed's role as the world's economic firefighter, each intervention making it harder to step back. By the early 2020s, the trap began to take shape. Inflation, sparked by pandemic stimulus and supply chain chaos, forced the Fed to pivot. Under Jerome Powell, it raised rates aggressively in 2022 and 2023, taming inflation from a 40-year high of 9.1% to a more manageable 3%. But the hikes came at a cost. Higher borrowing rates strained households, small businesses, and over-leveraged corporations. The stock market wobbled, and regional banks, caught off guard by rising rates, faced deposit flight reminiscent of 2023's Silicon Valley Bank collapse. Raising rates further risked a recession, but holding steady or cutting too soon could reignite inflation, especially with energy prices volatile and labor markets tight. The Fed's massive balance sheet was another shackle. Years of bond buying had left it holding trillions in treasuries and mortgage-backed securities. Unwinding this through quantitative tightening was meant to normalize policy, but selling assets too fast could spike yields, disrupt markets, and choke off growth. Keeping the balance sheet bloated, meanwhile, tied up capital and fueled criticism that the Fed was distorting markets. Every move seemed to carry a hidden cost, like a chess player surrounded by threats. Debt was the trap's tightest coil. U.S. federal debt had soared past $33 trillion by 2025, with interest payments eating up a growing share of the budget. Corporate and household debt, while not at 2008 levels, were high enough to make rate hikes perilous. Globally, emerging markets teetered under dollar-denominated debt, vulnerable to any Fed tightening that strengthened the dollar. The Fed's actions no longer affected just the U.S. They rippled across a world addicted to cheap credit. A misstep could trigger defaults, currency crises, or worse. Politically, the Fed was under siege. Its independence, once sacrosanct, faced attacks from both sides. Progressives argued it prioritized Wall Street over workers, pointing to low rates that fueled inequality. Conservatives, citing inflation and debt, demanded tighter policy and more oversight. Public trust, eroded by years of bailouts and bubbles, was at historic lows. In Congress, proposals to audit the Fed or tie its mandate to narrower goals gained traction. Even subtle rate decisions were now dissected on social media, with platforms like X amplifying outrage. The Fed, meant to operate above politics, was dragged into the fray. Technological shifts added another layer. The rise of cryptocurrencies and central bank digital currencies challenged the Fed's control over money. If private digital assets gained traction, the Fed's ability to steer the economy through interest rates could weaken. Meanwhile, climate risks and geopolitical tensions, trade wars, sanctions, energy shocks, complicated its forecasts. The world was messier than the models the Fed relied on, and its traditional levers felt increasingly blunt. By 2025, the Fed's predicament was clear. It was damned if it did, damned if it didn't. Raise rates, and it risked tipping the economy into recession, alienating a public already bruised by high costs. Cut rates, and it could unleash inflation or new asset bubbles, validating critics who saw it as reckless. Hold steady, and it might be accused of paralysis, prolonging uncertainty. The Fed's once godlike ability to shape markets was now a tightrope walk, with no clear path to safety. This trap position was more than a policy puzzle, it was a reckoning. Decades of intervention had made the Fed indispensable, yet its power came with chains. As Powell and his colleagues gathered in the Fed's Washington boardroom, the weight of their decisions loomed. They were no longer just managing money supply. They were navigating a fractured economy and a skeptical world. The Fed, for all its intellect and authority, was learning a humbling truth. Even the most powerful institutions can find themselves cornered, with nowhere to run. A house of cards. By the spring of 2025, the global economy stood like a house of cards, an intricate structure of debt, speculation, and central bank promises, trembling under the weight of its own fragility. Each card, low interest rates, bloated asset prices, soaring deficits, had been carefully placed over decades, building a facade of prosperity. But beneath the surface, cracks were spreading, and a single misstep threatened to bring it all crashing down. This was no abstract metaphor. It was the precarious reality of a financial system stretched to its limits, held together by little more than faith. The foundation was laid in the aftermath of the 2008 financial crisis. To avert collapse, the Federal Reserve and other central banks slashed interest rates to near zero and flooded markets with trillions through quantitative easing. The plan worked. Banks stabilized, stocks soared, and growth returned. But the fix came with a catch. It addicted the world to cheap money. Corporations borrowed to fund stock buybacks, not factories. Governments ran deficits, confident that low rates made debt manageable. Households, squeezed by stagnant wages, leaned on credit to maintain lifestyles. By 2025, global debt had climbed to $315 trillion, nearly triple global GDP, a towering card at the base of the structure. Asset markets formed the next layer. With safe investments like bonds yielding next to nothing, investors chased riskier bets. Stock markets hit record highs, driven by tech giants and speculative frenzies in cryptocurrencies and meme stocks. Real estate, too, became a fever dream. Home prices in major cities doubled in a decade, pricing out entire generations. The catch was leverage. Much of this wealth was borrowed, amplified by derivatives and margin debt. A single market correction could trigger a cascade of forced sales, shaking the house's fragile frame. Central banks, the architects of this edifice, were both its strength and its weakness. The Fed's balance sheet, swollen to $9 trillion, was a testament to its role as market backstop. Its put, the unspoken promise to intervene, kept investors bold. But this safety net had warped behavior. Banks took bigger risks, knowing bailouts were likely. Corporations issued junk bonds to fund shaky ventures. The moral hazard was palpable. Why build soundly when the Fed would cushion the fall? Yet, with inflation lingering and rates no longer at zero, the Fed's ability to prop up the system was waning, a card wobbling under strain. Debt was the house's most precarious layer. U.S. federal debt exceeded $33 trillion, with interest payments crowding out other spending. Corporate debt, at $13 trillion, included billions in low-rated bonds teetering on default. Emerging markets, saddled with dollar-denominated loans, faced ruin if the dollar strengthened. Even households, burdened by credit card and student loan debt, had little cushion. The system's interconnectedness meant a default in one corner, say, a failing hedge fund or a struggling nation, could ripple outward, tugging at every card. Geopolitical and social pressures added gusts to this shaky structure. Trade tensions, energy shocks, and climate-driven disruptions strained supply chains, keeping inflation volatile. Public trust in institutions, eroded by years of inequality and bailouts, fueled unrest. On platforms like X, voices decried a system that enriched the few while leaving workers behind. Populist demands for debt relief or tighter regulation clashed with Wall Street's calls for more liquidity, leaving policymakers paralyzed. The House, built on economic promises, was buffeted by a world no longer willing to wait. The final card was confidence. Markets ran on belief that central banks could manage crises, that debt could be rolled over, that growth would return. But by 2025, that faith was fraying. Inflation's return had exposed the limits of easy money. Rate hikes, meant to cool prices, squeezed borrowers, and sparked market tremors. Regional bank failures and corporate bankruptcies, though contained, hinted at deeper weaknesses. Whispers of a new bubble in AI stocks or green energy grew louder, each a potential spark near a tinder-dry structure. The House of Cards stood, for now, a monument to human ambition and hubris. Central bankers, aware of the fragility, moved cautiously, each rate decision scrutinized like a hand hovering near the stack. Investors, still chasing gains, added cards to the top, ignoring the creaks below. Ordinary people, caught in the shadow of this towering edifice, could only watch, knowing that if it fell, they'd bear the brunt. The question wasn't if the house would collapse, but when, and whether anything could be built from the wreckage. Conclusion. The Lords of Easy Money is a powerful and accessible indictment of the Federal Reserve's post-2008 policies, told through the lens of a principled dissenter and the broader societal fallout. Christopher Leonard succeeds in transforming the dry subject of monetary policy into a compelling morality tale, blending rigorous analysis with narrative flair. His focus on Thomas Hoenig provides a human anchor, while his exploration of QE's consequences, wealth inequality, corporate debt, and financial instability, offers a damning critique of the Fed's hubris. The book's strength lies in its clarity and readability, making complex economic concepts accessible to a general audience. Leonard's use of real-world examples, from zombie companies to struggling workers, grounds the narrative in the lived experiences of Americans. However, some critics have noted that the book's repetitive structure, crisis, stimulus, crisis, can feel like a slog, mirroring the cyclical nature of the Fed's interventions. Additionally, Leonard's reliance on Hoenig's perspective occasionally risks oversimplifying the Fed's internal dynamics, as other voices and competing rationales are given less weight. Ultimately, The Lords of Easy Money is a clarion call to rethink the Federal Reserve's unchecked power and its impact on American society. Leonard leaves readers with a sense of urgency and unease, warning that the economy's reliance on easy money is unsustainable. As inflation rages and markets teeter, the book serves as both a history lesson and a cautionary tale, urging policymakers and citizens alike to confront the fragile foundations of the modern economy. For those seeking to understand how we arrived at this precarious moment, Leonard's work is an essential and provocative guide.